What's going on, you guys? It's Cody Steck, your Utah realtor. We're back with another video. Today we're going to be talking a little bit about an article that was just released in the local newspaper. Well, I actually read it online. It wasn't actually in the newspaper, but we're talking about this article, and it's going to discuss a little bit about where the Utah real estate market is headed, and especially what one University of Utah economist has to say about our local housing market. Along the way, I'm going to be sharing my thoughts, my perspective from what I see working in the industry myself. And you know, I'm not the expert when it comes to all things unemployment and economy and all this stuff. I'm just the guy who loves selling real estate and loves hearing from people like yourself who are making that move here. If you are making that move here, make sure to get in touch with me, call me, text me, email me, get a hold of me any way that you need to so we can chat about your upcoming move here to Salt Lake City or any of the surrounding areas. I'd love to hear from you. Before we jump into this article, give me a thumbs up here on the video. Don't forget to subscribe to the channel, and let's get started. All right, so I'm going to be reading this off my phone as we go. The title of this article says, "Impact of COVID-19 on Utah Housing Sector Expected to be Significant." It starts out the article by saying, at the beginning of 2020, Utah housing experts were predicting the median home price in Salt Lake County to top $400,000 for the first time. Now, 3 months after the state shut down businesses, one economist is rethinking those rosy metrics from the state's once red-hot economy. The recession will cut residential construction and existing home sales by 8 to 10%. I do think that's true. The basis of this article is going to tell you that home sales are down because there's less inventory in the market. Going on, reading on further here in the article, writing in a Policy Institute blog post, the tenured professor and respected economist of 40 years says he's never seen economic conditions as uncertain and fast-moving as the current COVID-19 market due to extreme volatility expected in the Utah job market over the next several months. In January, Wood issued his annual forecast for the Salt Lake metro area, predicting that single-family homes would be over $400,000 for the first time, while the median price for condominiums and townhomes would climb 10% this year and possibly even reach $300,000 sometime next year. Now, an unforeseen historic event has created turmoil and resulted in the re-examination of the economic picture for the area and what impact the pandemic will have on housing for the second half of 2020. The good news is that in the second half of the year, employment growth returns, bringing the 2020 annual employment estimate to 1.529 million jobs, down only 31,000 jobs from 2019. So he's talking a little bit about unemployment here. I'm going to scroll down a little bit further, get to the interesting stuff that we want to see here. His housing forecast assumes job recovery by the fourth quarter, which also assumes the economic recovery will be preceded by near containment of COVID-19 through testing, treatment, and isolation of cases. However, there's still a lot of uncertainty around the virus itself. Uncertainty in the existing homeownership market due to the pandemic is expected to create challenges for buyers and sellers, Wood said, but stability in financial markets will help mitigate some of the ambiguity with mortgage rates still at historic lows. So this is a very important part. There is a decrease in inventory in the market right now. I have seen that, especially among older individuals, less of those older individuals are choosing to make a move during this time just because they're at higher risk, and that's totally understandable. They're generally in a position where if they own a home, they're probably a little bit more stable financially. They probably don't need to make a move, you know, as much as maybe a younger person or younger family would or would need to. So these older individuals are choosing not to move, which means that they're not putting their homes on the market, which then creates a trickle effect because those homes are typically a little bit on the higher end. You know, those are the second or even third level type of homes, you know, the homes that people have upgraded to. And so if those homes are not coming available, the people who are in that very first tier of homes are not able to upgrade to that next level. There's just not enough inventory there. And if those people on the first level can't upgrade to the next level, the people who are just trying to get into the market are going to have a way harder time, and they're going to see more competition and higher prices. Moving on a little bit in the article here, the performance of the residential real estate market in 2020 comes down to whether economic uncertainty offsets the advantage of low interest rates. He said there's going to be a share of both buyers and sellers who decide, well, maybe it's time to wait, but there's also going to be people who decide now's the time to jump in because rates are at historic lows. I've seen quotes for mortgage rates on 30-year fixed mortgages in the low 3%, you know, 3%, 3.1, 3.25. These are the types of rates that people are getting right now, which are insanely low. And so even though prices are high, yes, that's true, you can get really cheap money. Back to the article, he noted that job losses could significantly reduce second quarter demand from prospective homebuyers. Demand should pick up as the economy recovers during the latter half of this year. He said sales of existing homes, condos, and townhomes will likely finish down about 10%. A 10% drop, given everything that's going on, is really actually not too bad. So that's a little bit surprising there that they're estimating that. And despite the diminished demand, demand. This is one part that I don't necessarily agree with. I still think there's a ton of demand in the market. You can't say that there's diminished demand when there's literally 30, 40, 50 people looking at houses and they're going under contract with multiple offers. I can't tell you guys how many times over the last 2 weeks I've gone to showings and there's been numerous agents waiting to get into the house. I went to one the other day. There was a line of at least 20 different groups of people trying to get into this one house to see it. They kind of crammed everybody in, you know, one at a time because of the virus type thing. It was like an open house basically. They said this is the only time window you can come, so be there or you're out of luck, you know. So literally 30 people, they ended up with 14 offers on the house. I have a tough time saying that, you know, agreeing that there's not a ton of demand when you see those types of situations on houses like this. I mean, this is a great house kind of in the downtown area, great price range. There's a lot of demand there, so I'm not sure I personally agree with that. As far as what I'm seeing in the local market, there's still a lot of demand. So it says home prices will continue to increase, but at a slower pace. That's the important thing that's there to remember. You have to remember that home prices are going to increase. I agree with that. I do think the increased growth rate will slow down, like they said here, but prices are probably still going to go up. Everybody's expecting a crash. Everybody's waiting to see what happens. I shouldn't say everybody, but a lot of people are. You know, I think everybody's kind of on edge. I'm going to talk a little bit more about that at the end of the video, so make sure you stay tuned if you want to hear my thoughts on that. So it says, the dearth of available properties will put increasing pressure on sales prices. Exactly, there's still demand. If there's less inventory, that's going to push people to pay more for what is currently on the market. With the statewide median price of a residential property increasing by approximately 5% to $336,000 for the year. That includes houses, condos, and townhomes. After averaging annual increases of 5% for several years, Salt Lake County rental rates will be interrupted in 2020 as rents flatten or possibly decline 3 to 4%. The rental market is bound to see higher vacancy rates. Over the last 4 to 5 years, vacancy rates along the Wasatch Front have been below 4%. They're expecting that to inch up, 1 to 2% in the coming months. This is a little bit interesting to see. I think when they're looking at bigger scale, apartment buildings, I could see there being vacancy there. I have heard of that. I think when it comes to, the mom and pop type landlords who are typically renting single family homes or maybe a townhome here or there, I still think that the vacancy is going to be very low. There's still a lot of demand for that because the people who are not able to buy a home just yet because they can't afford it or because they're not ready or they don't want to maybe, those people are being forced to rent, and I still see there being very little on the market. When I go and do rent comparables, there's very little to look at. So it'll be interesting to see how the vacancy goes there. I don't think, I personally don't think rents will decline. I still think that there's just so much demand. Maybe in the apartment sector, the rents will decrease a little bit, but as far as the private sector goes, I still see rents being pretty strong and continuing to increase over the coming years because it's going to, somewhat match how the housing prices increase as well. So that kind of wraps up the video as far as how it concerns the Utah market specifically. I want to just share a little bit about, back up and share with you guys a little bit on my thoughts about the market and how to jump into this market if you're thinking about doing it and how you should move forward. I was reading the comments on this article, and there's a lot of comments mentioning, yeah, we need a crash, we need prices to go down, prices are ridiculous, and they are. They're as high as they've ever been, and that's totally understandable. There's a lot of people who can't afford homes. There's a lot of people who are incredibly surprised at how the cost of housing has gone up. But I think the thing that, I always try to remember is that, look, whether you like it or not, this is the reality. This is the reality, and so this is what we're faced with, and this is the game that you have to play. If you want to play it, you have to jump in and play by the rules that the market has set. So the best way to look at it, when you're looking at investing in real estate is, again, take a step back and look at how the market has performed over the last 10 years, over the last 20 years, over the last 30 years. Look at any period of time that is at least 10 to 15 years, probably let's say 15 years or more. You're going to see that prices have gone up. This is the exact reason why 100 years ago you could buy a Sears home kit for a couple $1,000s. This is the exact same reason why your grandpa was able to buy a house with 5 acres on it for $14,000. As time goes on, you're going to see that home prices will continue to increase. So that $400,000 house that you're looking at right now, it's going to be worth $650,000 in 20 years. So I always kind of step back and I say, well, one, if you're looking to be a home buyer, try to make the best decision that you can. Try to get into something that you can, maybe you need to get roommates. Maybe you need to get something smaller. Maybe you need to sacrifice a little bit of space, get something that's more affordable so that you can get started with it. Maybe you need to find something to house hack, which I've talked about numerous times here on the channel, so that you can get into something that is, you can rent out part of the house and help cover your mortgage that way. Look at these different options to figure out how to be a home buyer. If you're looking to invest in real estate, I always kind of step back and take the same approach as like dollar cost averaging. A lot of the real estate investors that I know are still investing in the market. Despite these high prices, they're still looking for good deals and they're still making investments into the market. So there's still deals out there to be had, and a lot of people who have a lot of experience are still jumping into the market. So take that dollar cost averaging approach like you would in the stock market, right? Which is basically take $100 every paycheck that you get and just put it into the market, put it in, and you just do that a little bit over time regardless of how the prices go, and you're going to set yourself up. Stock prices are at all-time highs as well, of course, pending the pandemic that we've had, but recently, the stock market's going absolutely nuts, and people are kind of saying the same thing there. They wish stocks would crash or whatever so they could get in for cheaper, but you got to get in, you got to play the game, and it's been proven time and time again that dollar cost averaging is the safest and one of the most reliable ways to actually invest in the stock market. So looking at real estate, it should be the same way. Try to get into something now, make sure that it makes sense for you now, it's a safe investment, and if the market crashes, great, that's your time to buy a second home, that's your time to buy a third home, maybe that's the time to upgrade when you've got still low interest rates and home prices are down. This is the time where you need to see that. This is the time when you need to do that. It's going to be interesting to see how things go. I don't know where things are headed. I think that as long as mortgage rates stay low, that home prices will continue to stay propped up. Everybody's saying there will be a bubble or this or that. I don't know. I'm no expert when it comes to the national or the global economy. But what I see here in the market is I see that over the long term, prices will continue to go up, and I think that that's fairly, I feel very confident in that, because you can look over any period of time in history and that's what's happened. I think if prices don't go up, then we've got bigger problems. Over the long run, there's so much growth and demand here in Utah that it's going to continue to see that type of increase over the coming years. We might be the next California, the next Washington, or the next New York, where prices are just incredibly high. Is that what we want? Maybe not. I don't know. Everybody's in a little bit different position. If you own real estate, it's great. If you're just getting in, it's going to be a little bit tougher. But like I said, you got to play the game the way it goes. So guys, that's enough of my rambling. Enough about this. I want to thank you for watching all the way to the end. If you made it this far, get in touch with me if you're making a move here. Don't forget to give me a thumbs up here on the video. Subscribe to the channel, and I'll catch you in the next one.